Let's talk about the mechanics of the capital raising or underwriting process. The book building process starts with a prospectus price range, where there's a range of prices that investment bankers expect investors to be interested in. From there, the price can be narrowed to an institutional investor commitment at a more firm price. This is how the book of demand is built. So orders come in at certain prices from institutional investors, and the bankers then have this list of orders, or book of demand as they call it, that they build and to justify the pricing. And then finally, a price is set to ensure clearing based on the book of orders. So the investment bankers can look at all the orders that have come in from institutional investors and decide what the clearing price will be so the issue is fully closed. Finally, the orders are allocated. Some investors might not get all of the orders that they wanted. If the book is called oversubscribed, then some may get less than they asked for. The roadshow process. So the roadshow is an often talked about part of capital raising. And this is when management literally goes on the road with the investment bankers and goes to meet the institutional investors that are going to be buying this investment. There are a few areas that are critical to a successful roadshow. The first is understanding management structure and governance. Investors are adamant that management structure and governance must be conducive to creating good returns. Additionally, the investors will want to know the key risks of the business. Although not positive, it is important to highlight the risks and be upfront about them. The next is strategy, both tactical and long-term. What are the strategic initiatives of this business? How is it going to create sustainable value over the long run? Who are the main competitors? Again, not a positive, but something that needs to be highlighted and, if spun in the right way, can demonstrate a leg up over the competition. It's always important to outline what the funding purpose is. What is the cash going to be used for after it's raised? Investors like to see a good use of proceeds. And finally, there needs to be a thorough analysis of the industry or sector, looking at trends in the industry, not just for this company that's raising the money, but for the industry as a whole. Let's move on to talk about some of the key issues in pricing and offering. One is price stability. After the offering is completed, investors do not want a lot of volatility, so price stability is very important. A buoyant aftermarket. If there is going to be volatility, it should hopefully be to the upside with a strong market, and certainly not to the downside. A deep investor base will help achieve this. Having a large number of investors in an issue as opposed to just one or two highly concentrated investors will help stabilize and make a deep aftermarket. And finally, access to the market is always going to be critical. So in pricing the issue, there are a couple of trade-offs. There's tension in the choices. The first is having strong aftermarket price performance on one side, but on the other side, not underpricing too much so that money is left on the table. So you want to price it just low enough that there's good aftermarket performance, but not so low that the issuer is feeling that they've left money on the table. Let's talk about costs associated with the flotation. One is reducing the risk of an equity overhang, and the other is ensuring a buoyant aftermarket. But there's a temptation from the bank to underprice the issue. Why? Because they want to get the deal done, and because they want to reduce the chance of being caught with an equity overhang, which is another way of saying unsold equity at the end of the deal. So Reducing the risk of an equity overhang helps ensure a buoyant aftermarket, but it doesn't necessarily get the best returns for the current owners, which is to say the highest price of the issue. So there is a lot of complexity around pricing an issue, of getting the issue to sell, but also not pricing it too low and having the right balance. So if we review the IPO pricing process, we start by determining the full value of a business. This is done by a combination of discounted cash flow analysis, comparable company analysis, precedent transactions, etc. And we have other courses on valuation techniques. If you want to do a deep dive into financial modeling or business valuation, please check out our various courses on financial modeling and business valuation. So you get the full value of a business by these methods. From there, you deduct an IPO discount. So we come in a little bit lower than the intrinsic value or full value of the business to price the offering. After deducting the IPO discount, we arrive at the pricing range, a minimum and maximum price that we believe institutional investors will fill this issue at. Typically 10 to 15% is a normal range for the indicative minimum and maximum prices. Finally, at the end of the day, the issue will be priced, typically within the range, but it may be priced outside the range in the case of a very heavily oversubscribed offering, or it may be repriced below the range if demand is lower than expected. At the end of the day, it's ultimately up to the institutional investors to determine the price of the offering.